everyone, this is Rob Keens with the Freedom Report, formerly Gold Silver Pros. For those of you that were on my old channel name, we have got a lot to talk about. I've been gone for a couple of weeks doing the weekly market wrap-up because I did go to the Bitcoin conference and was working on a lot of other things behind the scenes. I've gotten very busy behind the scenes, but there's a lot to cover. So I'm going to cover 2 weeks here. We'll go back to our weekly report. I'm not sure I'm going to be traveling for conferences that much the rest of the summer. So we'll come back to our weekly market wrap-ups, but there's been so much going on the last couple of weeks, from the yen to the stock markets to a lot of other stuff, the Bitcoin announcement. I'm going to cover it all in this video. It's going to probably be a much longer video than normal, but I'm going to go through as quick as possible. There's also just news down, being shoved down our throat. I originally thought the summer would be a little slow in gold and silver, and it was up until now, and now it's starting to get really frothy. Part of that's election season, part of that's because of global fiat currency systems are imploding, and we're definitely get into that. And I'm going to talk quite a bit about gold and silver. I was going to do a very deep sort of analysis on gold and silver technical, which I think I'm going to save for next week because gold hasn't launched yet. I'm going to tell you what it looks like, but there's so much news flow and so much going on with regards to the rest of the markets. I'm going to focus on that this week and then give you the general gold treatment. And then next week, I'm going to come back and hit you with a much deeper gold and silver dive on the technical charts. There's actually a lot to talk about there, Anyway, that'll set it up. So let's just jump into it. As you guys know from me doing this, I don't know, 100, 200 times in the past, every week, we're going to go over the economic data. I'll do that real quick. So the ISM Services Index, that's a measure of people's outlook on the service sector, which is the biggest sector in America, actually rose to 51.4%. Anything over 50 is considered bullish. It's only 1.4% over 50, so we're not going to get too excited. But that was nicer than the previous months, which is a 48.8. So services is rotating between slight contraction and slight growth. It's basically zero, and when you factor out inflation, it's not really growing at all. That's the big thing to understand from that. But we are still at a point where some businesses are doing okay. The economy hasn't completely collapsed yet, so that makes sense in the data. The U.S. trade deficit, negative 73.1 billion. It just means the strength of our dollar and our economy leads us to spend more on external services than we get for shipping our goods out. We're no longer a manufacturing nation. And that does ultimately contribute to more dollar creation and the eventual collapse of what we think is going to be the dollar currency, which is why I talk about that one. Last week, a couple of big reports. ADP employment came under at 122,000 new jobs created, where the previous month is 155, and experts expected 150. The employment cost index abated slightly. The cost to employ people was up 1.2% last month, or I'm sorry, 2 months ago. And then the last month number, which just came out last week, was up 0.9%. So employment costs are rising, but not rising as much. So the wage inflation is starting to come down just a tad because companies can't afford wage inflation. And that's a sign that companies are in trouble. Employers are a bit in trouble in terms of what they can afford. Inflation is now starting to affect the employers, not just the employees. The Chicago Business Barometer Purchasing Manager Index, which is an indication of wholesale demand in Chicago, has fallen from 47.4 to 45.3. So last few months, it's been in negative territory. It just means that area of the country is not expecting a lot of growth. Pending home sales were up a little bit. They crashed last month to negative 2.1%. They're up now 4.8%. So those are flipping back and forth, but basically the housing market is essentially flatlined. Prices are up. The S&P Case-Shiller Home Index for prices is up 6.8%. That fell a little bit. So what's happening is there's less demand for homes, even though pending home sales is up a little bit this month. It may seem confusing. Overall, for the last year, it's not. And what's happening is that's forcing people to reduce prices. The interest rates were killing people on mortgages. And with the prices rising along with the interest rate, it just the top line number to own a home has gone up. So I told you a couple months ago, builders are building smaller homes. They're focusing on smaller homes, and the prices are coming down just a bit. So a lot of stress in the real estate market. It started with commercial real estate a couple of years ago with all of the vacancies you see around you in commercial and retail. And the business sector, I think the shutdowns in 2020 affected that. A lot of companies didn't renew leases. So there's a lot of excess commercial business space, but it's now starting to affect the residential market as well. So residential is starting to have some issues. Okay, if you look at the government jobs report, if we get back to it, the U.S. unemployment rate, the U3 that's quoted, is now up to 4.3%. It's up 2 months ago, it was 3.9. Now we're up over 4%. Employment's getting worse. It's become very obvious. There are more initial jobless claims. It's 249,000. We were expected to have only 235, and last month it was 235. It's up. So more initial jobless claims. Wages are coming down because employers can't afford it. And also the amount of jobs available are coming down. So employers are starting to suffer, and you're starting to see that in the economy. And if you look at the earnings reports the last couple of quarters, they've been weakening. And we'll get more into the stock market here in a moment. That's big. And we'll talk about the stock market here in a moment, what's going on there. Like I said, so much, I'm going to try to put it all together for you, but that's the initial data part of it. Let's go to the markets. Yesterday, the Dow crashed over 1,000 points. You had the NASDAQ and the S&P down. You had Chinese markets down. You had the Japanese market down. They've recovered. Dow has rallied 500 points at time of this report, about 4 p.m. No, closes nearly 300 points higher. So 300-point rebound after a 1,000-point loss. So it did not retrace all its gains. And the market now is basically desperate for the Fed to ease. The market needs cuts. They need money printing. They need all of it, because I think that the U.S. stock market, along with other stock markets around the world, are in big trouble. We'll talk about the Japanese carry trade here in a moment and what that means, and a lot of new concepts to introduce to you guys today. Overall, what's interesting to me is, though the stock markets were down, we're going to take a look at bonds, which is a bigger, more robust market in the U.S. And what I noticed is that rates had come down. The 2-year has come down to 3.989. It's actually up slightly today, up 0.108, but it's been down over the last several weeks. And the 10-year is at 3.9. So you're looking at a yield curve inversion of only 0.089 between the 10 and 2-year. In other words, they're starting to come together. And usually that occurs when there's less risk in the market. The yield curve inversion means that people demand higher rates for shorter term bonds because they expect a recession in the short term. That indicator has been going off for the last almost full year. And over history, when shorter term bonds demand higher rates, people want more to invest. If they're going to give you $1,000, they want a higher interest rate back, is because they expect a recession in the shorter term. That's why the shorter term part of the bond market will have higher rates. Typically, the shorter term has lower rates, because let's say we're coming out of our last recession and we know things are good. The bond rates, the 10-year is going to be higher than the 2 because you're putting your money in for longer. There's more risk. Over time, you don't know what's going to happen, but it's been inverted because people think there's immediate risk. Well, now that's flattening. And I think the bond market was responding to some positive momentum in the stock market and in earnings reports. But as those flip, I think the bond market yield curve is going to reinvert again. But I also think that the Fed and the Treasury are in the bond markets trying to shorten the yield curve, affect the yield curve, and sort of shorten that inversion. I think that's temporary. I don't think it's going to last. On to the cryptocurrencies. What we're looking at there, Bitcoin had a crash. It was down like 5,000 yesterday, something like that, 4,000 something. Now it's up 32.10. So right now Bitcoin's at 56,366.42. When I was at the Bitcoin conference, it peaked at around 68 something. So it's down about 12,000 over the last week to 10 days or so. From the announcement of the Bitcoin plan, which we'll get into here in a moment, that both RFK and Trump announced, slightly different versions. I'll explain that to you. And Ethereum, is at 24.85. Litecoin 58.51. They're all up slightly today. XRP is up to 51 cents. Stellar Lumen's up to 9 cents. Cardano up to 33 cents. Polygon up to 41 cents. All of the cryptocurrencies seem to be doing a little bit better, but they did crash, definitely. There's a sell-off in markets, which I'll get to here in a moment after I get through reading the data. I want to now go into news stories, of which I have a ton, and it's going to spend a long time on that. And then I'll get into some more stuff on the markets, and then ended up with gold and silver. I think you guys will be interested in what we have there. Here's a title from Zero Hedge: Retail Traders Furious as outages hit major U.S. brokerages amid Black Monday chaos. Quote, U.S. retail traders are panicking this morning after likely receiving push notifications on their smartphones about market turmoil in Asia and Europe, which has since spread to the U.S. pre-market. That's pre of the U.S. opening Monday morning. Now that cash session is about 15 minutes underway, the website notices Website monitor Down Detector reports outages are emerging across several major U.S. brokerage houses as everyone tries to log into their accounts and sell stocks. If you're a stock market and you believe that you'll have time to sell before the crash, what happens if your broker doesn't allow you to log in? Didn't that happen during the last crash in 2008 where people couldn't get access to their funds and sell their... I do believe there were hundreds of reported, thousands of reported cases of that. Interesting how when the market goes down, they don't necessarily want you to sell. If it goes up, you can buy and sell as much as you want. But if it's going to go down, nobody wants you to sell. Why? A lot of trading on margin. It could bankrupt some brokers. They have to have time to do their margin calls and liquidate positions. And they can't handle that if everybody's logging on at once. And it's a herd mentality in the stock market. Once somebody starts selling, everybody does. And that's a big issue. Quoting from the article again, Down Detector reports that users of Charles Schwab, Fidelity, Ameritrade, Vanguard, and E-Trade are all reporting website outages, which have been surging around the start of the U.S. cash session. There you go. Black Monday, futures plummet as VIX hits 62. That's the volatility index or the fear index. Japan suffers worst point drop in history. All the markets went down, including Japan. I'll explain why in a moment. That was another headline. I'm going to talk about the yen carry trade. So when I got into Forex and got my Series 3 license years ago, I don't have it anymore. I'm not licensed in anything in the U.S. right now. But back in the day, I worked for FXCM, which is currency broker. They had their own issues. Thank God I left before all those issues came to light. But I got my Series 3 and we learned about commodities and we learned about Forex or the trade between currency pairs, you know, US to yen, US to pound, all that kind of stuff. Relative valuations of the currencies to each other based upon economic data, amount of currency printing, all that good stuff. The yen carry trade is crashing. So if you look at what the Japanese have done, they've been operating at about a 0% interest rate for forever. Why they have to do that? Because they had a demographic issue where they had more people retiring than coming in. Their economy, they needed to do something to address that issue and need to do something to address previous inflation issues. So they set their interest rate at basically 0% for a long time. Their debt wasn't yielding anything, but the rest of the world would buy it because they believed in Japan and they had all this excess money floating around from everybody inflating their currencies. And so people bought the yen at 0 and then the 0% rate free, basically. And they turn around and put it into other products that had a return. So you could get the yen cheaply and put it into other currencies or anything else that had a return. Well, when the Japanese central bank raised interest rates, it amounted to about a 5% increase in the cost of that. And so it caused everybody to sell out of that yen carry trade, saying, well, it's no longer free. So we're going to get out of it. That's crushed our margins. So we knew, and I talked about this in my book when I wrote it 15 years ago. I said either Japan or Europe is going to be the start of the global fiat currency system collapse. I said this 15 years ago in my book, Drop Shadow. And you guys can buy it if you want a copy on Amazon. It's still out there for $7 or $8. And you can read that I wrote this. I said it's either going to be Japan or Europe. And either it would be Greece and all the southern states in Europe dragging down the euro, or it would be Japan finally blowing up. The central bank needed to raise rates to protect the falling value of the yen to the US dollar. When they did, everybody got out of the carry trade. And they dumped, and they're dumping not only the yen, but they're dumping Japanese debt. And that's causing Japan to crash. It's caused their stock market to crash. Well, that caused a panic in the world markets because you're upsetting something that people have taken for granted for multiple decades. And it's changed the dynamics of the entire market. A lot of people got margin called. That's why a lot of the brokerages shut their online, doors, so to speak, so people couldn't log in. They were trying to stop the contagion from spreading around the world. And it may have pissed people off, but it may have stopped a worldwide worldwide stock market collapse caused by the Japanese central bank changing their policy on their currency, because they're at the end, and what they're doing, they're easing, their permanent easing status is no longer working and it's blowing up, and the rest of the world is no longer going to support Japan if they need to enact their own monetary policy. And so Japan's on its own. Japan has already crashed. And no matter what they do, I don't see the US, China, Russia, and everybody else stepping in to save them, because they can't. Because now everybody else is in a similar boat to Japan. And so that has caused just all sorts of market chaos. Another article, the descent is starting. Stellantis CEO has his back against the wall trying to sell Jeeps. All of a sudden, Stellantis is having trouble selling Jeeps as auto manufacturer. And it comes at a time when SUV demand has never been greater. Stellantis Ram pickup division has also slipped in sales rankings, and Chrysler now only produces minivans. This decline resulted in poor earnings and a 40% stock drop from March highs recently. 7 senior executives have also departed since January. CEO Carlos Tavares, who recently secured a massive 36.5 million euro compensation package, has faced rapid setbacks. His strategy to protect profit margins led to higher prices for outdated products compared to competitors, resulting in lost market share and increased inventory, Bloomberg reported this week, originally from a Bloomberg story. Pierre-Olivier Essig, a London-based equities analyst at Air Capital, told Bloomberg, quote, "The descent is starting and Tavares has his back against the wall. The cost cutting is exhausted and there isn't enough innovation." This is the start of the fall of one of the major U.S. automakers because people can't afford to buy cars. And it's not just going to be Stellantis and Chrysler and Dodge and Jeep. It's going to be the entire U.S. auto sector, which we covered several months ago, but now you're starting to see it collapse. Back to jobs, initial jobless claims surged to 12 months high. We covered that. Let's go to, this is an interesting one. Quote from an article, anti-immigration protests in the UK spreads as Elon Musk warns civil war is inevitable. That's why we renamed the channel of the Freedom Report. It's not just about the money, it's about the culture and the politics. And listen to what we've got here reported. European countries on the front line, such as Greece and Italy, have been overwhelmed with migrants over the years due to failed open border policies facilitated by radical leftist politicians, according to the article. The unaccountable leaders, elected and unelected, have created a perfect storm of migrant crime and chaos across the continent. Now, weekend anti-immigration demonstrations were seen in Liverpool, Bristol, Manchester, Hull, Belfast, Stoke, and other cities. Some turned violent while others did not. By the way, the BBC has been caught red-handed saying the ones in Liverpool were mostly non-violent, where people were arrested, people were attacked, and people were bloodied. And so the press is covering it up. It's been well suppressed. Citizens are reportedly enraged with progressive officials who promoted open borders, leading to an influx of immigrants. This has resulted in increased crime and chaos and has adversely affected working class families by pushing down wages for low-skilled jobs. The Guardian, a newspaper that's reporting on this, quoted protesters on Saturday as chanting, "Get them out," and Yorkshire. In the southwest city of Bristol, folks shouted, "We want our country back," while others yelled, "England till I die." Some of this is being pulled from Twitter, and I'm pulling from different sources. There were small pockets of counter-protesters who called anti-immigration protesters racist. According to Radio Genoa, F Islam, F short for the 4-letter word, shouted British patriots in London, UK one step away from civil war, according to Radio Genoa. Queen Natalie, who's just a commenter, said, "Folks are not happy about the two-tier judicial system. Where have we seen this before? Where the migrants are being protected and the regular British are being persecuted." Big cultural war going on. I had a report from a friend who lives in London just this morning on a conference call that a business friend who says there's very few Anglican or white English speaking or just any English speaking people in London now. It's been taken over by people who don't even speak English. So apparently some people think Elon Musk thinks civil war is inevitable in the UK. I don't know if that's true. It's his opinion, but a lot of people are reporting this is a big issue, and the press is covering it up, and it's causing what looks like strife in one of the major countries in the world. Major trade partner with Europe, major trade partner with the US, but beyond that, it looks like UK society on some level is starting to collapse. So don't want it to collapse fully, but it looks like it's collapsing. Senator Graham, Lindsey Graham, pushes senators to commit to war on Iran if Israel attacked. Iran state TV suggests attack on Israel is just hours away. This is a report on Friday. It hasn't happened this way, but according to OSINT Defender, which I think sometimes is a little bit propagandist, but does have good information, a Twitter post, quote, "A news anchor with Iranian Channel 3, in coming hours, the world will witness extraordinary scenes and very important developments." This is on Twitter. Iranian state news anchor reported, "In the coming hours, the world will witness extraordinary scenes and very important developments." Iran International publication and other regional publications have highlighted the alarming clip as well. Times of Israel, Hezbollah is activating its senior personnel from the terror group strongholds in the southern suburbs of Beirut in anticipation of potential Israeli strikes, Arabic media sources reported today or Friday. What I say last year when all this kicked off, in the Gaza Strip, or early this year, last year, that time frame, and the Ukraine. So last year was Ukraine, and then after that, Israel, Gaza. I said this could lead to that entire region blowing up, and it could eventually lead to World War III. I talked about 10 years ago, me being at school. I went to military college for my master's, and how they said it would probably be these two areas of the world, and it wouldn't be too long. And lo and behold, 10 years later, look at what's happening. I don't know if we're going to World War III, but it certainly looks like it. Why does that matter? Because we go to World War III, the entire financial system will have either already collapsed or will collapse during that process. It's causing so much dislocation in business with sanctions and with trade, and it's destroying societies, it's destroying growth, and you can't have growth when you're worried about war and people are war spending. I mean, you can have growth, but it's in the wrong sectors. And so if you look throughout history, war and economic collapse go hand in hand. And I think that's what we're witnessing, is more wars and economic collapse going hand in hand. According to Andrew Thornbrook via the Epoch Times, a report finds U.S. military lacks the ability to defeat China, suggests more of a Cold War style defense spending. A new congressional report suggests that the U.S. military lacks the required capabilities to preserve the nation's strategic interests and could lose a potential war against China. I can tell you right now, it's because we're spread out. We spent too much and we don't have enough. And they've developed more defenses and more offenses than they previously had. Now, from an aircraft carrier and a naval situation, they are developing blue water navies, meaning they don't have to stay near the coast. They can venture out and be refueled in that way, much like the U.S. and the British. They're not quite there at the naval perspective, but in terms of nuclear capability, they're probably better than the U.S., if I'm being honest. In terms of land, they're pretty good. Now, their training may not quite be up to U.S., but they outnumber us, and they have a lot of missile reserves and things like that. So this report is coming from the fact that given the situation with the U.S. military being spread out and the advancements in China, and I would also add Russia, but specifically for China, the U.S. Congress, in a report, is saying the U.S. could not defeat China. That's going to shock many of you. Eric Edelman, who serves as the vice chairman for the commission, told the Senate Armed Services Committee on Tuesday that China's communist regime was outpacing the United States in military development. He said the fact could increase the likelihood of a conflict between the two powers and the likelihood of the United States losing. There's a potential for a near-term war and potential we might lose such a conflict, Mr. Edelman said. He's telling the Armed Services Committee, he served as a chair for the Congressional Commission. This is not conspiracy theory. This is not me. This is the U.S. Congress telling you we would lose a war with China. Now, are they just ginning up more support for war spending, or are they being honest? In my own estimation, I'm not a military expert, China and the U.S., given how the U.S. is spread out, you know, if you got all the U.S. forces together against all the Chinese forces and are on the same battlefield and you did a war game there, the U.S. may win. But given the situation, given the financial situation, given the spread out nature of the U.S. military, given the advancements in the Chinese military, including stealth aircraft and missile technology, hypersonic missiles, nuclear missiles, it's not conclusive that the U.S. would beat China right now today if we squared off. That's according to your U.S. Congress reporting to the Senate Armed Services Committee. And that increases the likelihood for war. Why? Because the U.S. has been beating up the rest of the world with its inflation as a reserve currency, and it's pissed everybody off. And with this financial collapse that we almost witnessed at the beginning of this week and on Friday, it leads to war, and the U.S. Congress is telling you that in public. It ain't me, it's them. Mr. Edelman goes on to say, it makes each of these countries potentially stronger military, economically, and diplomatically, and potentially can weaken the tools we have at our disposal to deal with them. He's talking about the shift in partnerships between China, Iran, North Korea, and Russia, a major strategic shift that U.S. defense planners failed to fully account for. What channel was telling you that last year when all this started? The one you're on right now. And that's why I renamed it to the Freedom Report, because it ain't just about finance anymore. It's about everything that's going on. It's about, are we going to be free anymore? Is anywhere in the world going to be free? Freedom is being threatened existentially right now in front of your face. Iran says it must punish Israel, from a news story, begins clearing airspace. Biden to hold Situation Room meeting. Axios has reported Sunday that the message being conveyed abroad by Secretary of State Anthony Blinken is that while Washington doesn't know the exact timing of the attacks, they could start as early as the next 24 to 48 hours, which would mean as soon as Monday. This was on Monday, talking about the situation with regards to the Middle East, Israel and Iran. Separately, a Wall Street Journal article was particularly alarming, given it said that Iran has told Arab diplomats that it didn't care if the response triggered a war. When they tried to urge de-escalation and calm, foreign ministers from Lebanon and Jordan had been in Iran trying to talk officials down from initiating a major attack. Tehran, in a fresh statement, said its intent is not to escalate, but to punish Israel on Wednesday for the killing of Hamas political leader 𝙁𝙊𝙀𝙀𝙎 on Iranian soil, and that it won't be dissuaded. Sorry if I got that name wrong. 𝙁𝙊𝙀𝙀𝙎. 𝙁𝙊𝙀𝙀. 𝙁𝙊𝙀𝙀𝙀. Quote, Iran seeks to establish stability in the region, but this will only come with punishing the aggressor and creating deterrence against the adventurism of the Zionist regime, according to the words of Iranian Foreign Ministry spokesman Nassar Kanani. Kanani further blasted the United States and international community for providing continued support and cover to Israel, saying instead all countries should back pursuing the punishment of the aggressor. Also, Islamic Revolutionary Guard Corps Chief Hossein Salami has warned that Israel was digging its own grave and that will receive punishment in due time. He indicated that it was not just due to the 𝙁𝙊𝙀𝙀 killing, but a string of covert killings and sabotage actions against the Islamic Republic. Iran on Monday reportedly began clearing out its airspace by issuing NOTAM reports, notice to air missions alert. According to Matt Tardio from Twitter, Iran has issued a NOTAM, a notice alerting an aircraft of endangers en route for the center, west, and northwest of the country, advising aircraft to change their routes. We're talking about like commercial aircraft and any other aircraft, private aircraft. Iran has issued NOTAMs over their airspace. Flights in Iran are thinning out. Air traffic over Iraq seems to have increased heavily. And more. It looks like we may be blowing up into not only regional war, but potentially a world war. How many of you are paying attention? Are you watching the Olympics, which I love, by the way, and I'm watching, or are you paying attention to what's going on around you? I'm glad that you guys are here today. We're talking about all sorts of stuff way beyond gold and silver. That was that article. Now we're going to talk about the wipeout that happened on Monday. It was $1 trillion wipeout. I'm going to share screen. We're going to go into what we've got there. And oh, baby, does this get interesting. According to CNBC yesterday, $1 trillion wipeout market rout punishes mega cap tech. Why does that matter? I'm going to show you in a minute why that matters, ladies and gentlemen. We're going to get to this. I'm going to take a brief pause, and then I'm going to load a video of Stephen Hochberg, who was on my channel 5 months ago, who predicted this exact very thing. And he said it would happen over the summer. And he said it 5 months ago. If you'd been on our channel 5 months ago, maybe you would have been prepared for this. Hopefully you guys were. Hopefully you guys watched it and you're prepared. If you weren't, and it was on my channel, and you experienced some of this market pain, I'm sorry, we predicted it 5 months ago. According to CNBC, the 7 most valuable U.S. tech companies lost a combined $1 trillion in market value at the start of trading on Monday. The tech-heavy NASDAQ was down more than 3%, following the index's steepest three-week slide in 2 years. NVIDIA fell about 6%, and Apple was down more than 4%. NVIDIA, this quote from the CNBC article, NVIDIA shed more than $300 billion in market cap at the opening bell, though it quickly recovered about half of its loss. Shares of the chip maker closed down 6.4%. Apple and Amazon's valuation plummeted $224 billion and $109 billion respectively at the market open. Apple ended down 4.8% or $162 billion in market cap. Amazon dropped 4.1% at the close, or $72 billion. Add that to the steep declines in Meta, Microsoft, Alphabet, and Tesla, and the 7 most valuable tech companies lost $1 trillion, almost $1 trillion, in the early moments of trading, $995 billion. They bounced back, and they bounced back some today, but these were holding up the market. And wait until you see the interview with Stephen where he said the next crash is going to come when these 7 companies have trouble. And what happened? Stay tuned for that. I'm going to load that video up and be right back into. All right, this is a video I uploaded real quickly from Stephen Hochberg. He came on our channel, I want to say January or February. And he was talking about what was going to happen in the stock market. He saw a pullback, an Elliott Wave analyst, saw it happening this summer. And he further went on to say when the 7 big tech companies have problems, that's the start of a big collapse on a chart dating back to the 1800s, if you look at it that way. So this is going to be a big cyclical collapse he's predicting. Listen to what he says here and said on our channel about 5-6 months ago.
So in terms of Elliott, we're at what we call a grand super cycle top. meaning that it's just a long wave of rally that started. We can date it back to maybe the 1932 low. We can even go back to the early 1700s, depending upon the degree we're looking at. On a shorter term, from the 1974 low, from the 2008 low, all of these patterns are culminating right now together in what we think is going to be a pretty significant top in the stock market. So when you talk about transition, I think, yeah, 2024 is going to be an extremely interesting year, where we transition from, and I think we've already started it. For example, the Russell 2000 topped all the way back in November of 2021. So did the Dow Jones Transportation Average. So did the Value Line Composite, the mid caps, S&P mid caps. So we're in this process where one sector after another seems to be peeling away from the uptrend, and what we have left here is basically the Dow, the S&P, and 7 quote magnificent stocks that are lifting the market up. And I think when those stocks finally turn, I think the market's going to go into what we believe is going to be a pretty significant bear market. I think you're going to have a lot of money liquid and available, so that once stocks go through this period of decline that we think they're going to go through, you can walk in and pick them up for what cents on the dollar. And that's kind of where our view is going forward in 2024 in the next year or two.
So there you go. There are patterns. I've talked about patterns in society many times, and there definitely was a pattern in the stock market. Now, is it all going to collapse today, right now? No, I think it's a process where it collapses, but I think this is the warning. This is your last warning that the big collapse is coming. And if you weren't convinced by all the wars that were going on, if you weren't convinced by the collapse of the near collapse of the yen, well, it is an ongoing collapse, but the near almost just a hyperinflationary collapse. If you weren't convinced by the blow up of the carry trade, if you weren't convinced by all the stock market meltdowns, hopefully you'll be convinced by that when all of this stuff happens, it is predictable, and you look at the data. And I think that's why you guys come to my channel, and I have those kind of guests on, is to teach you those things and to tell you those things, because it matters. And honestly, that's what we're experiencing. One other thing that I wanted to show you was on government reporting. So I'm adding this kind of at the end of this discussion before I get into gold and silver. So we're 32 minutes in. I will get into gold and silver, but I want to show you this interesting chart. This is originally from Zero Hedge, you can see at the top. And then we're comparing Zillow, which is the black line, rent valuations with CPI. So we talked, I want to say 2 weeks ago, about CPI lie. I did a video on that, and I took you through my book where in chapter 2 I talked about this. You can see it another way. You can just look at the government's numbers on housing inflation or rent inflation, and you can see the real numbers from Zillow, what's being reported by actual users. This is what the government does. They smooth this out and make it look like it's not nearly as bad as what you see in the actual real world. This is why you cannot trust government data, because they're not going to tell you the truth. They're not telling us the truth. We're not getting the truth from them, and you cannot believe their statistics. And this is why the market is crashing, and the financial media and the financial sector don't understand, because they believe this blue number. They believe everything's hunky-dory and it just goes in this nice wave and we're all going to be okay. They don't get what people are really seeing. And this is just a perfect chart to illustrate where the government numbers are bunks. I wanted to throw that in there. All right, on to gold and silver. We're going to do a real quick gold and silver. Next week, I'll do a more in-depth study of gold and silver, I promise. This is interesting, though. You had an increase in open interest, and at the same time, you had some of the bullion banks dropping shorts. This doesn't happen that often. I think what has happened is usually during the summer, the bullion banks will increase their shorts because the price will fall, and they'll take advantage of that by having short positions and making money. They're releasing shorts right now earlier than anticipated. Usually it doesn't happen until the first couple of weeks of September in anticipation of the fall trade coming back to gold and silver and the rest of the financial sector. But with all the news happening, gold and silver are getting more interest across the world. And so the bullion banks are having to drop some of their shorts. I'm going to show you that. And it's allowing the price not necessarily to rise a lot, but not to crash like it typically does in the summer. And I started off a few weeks ago saying this is going to be the summer doldrums in the markets. Then we had the assassination attempt of Trump, and then we had what's going on with the rest of the markets starting to collapse and have issues. And now that's all off. I think the summer is, I reverse course, and I think the summer is going to be actually quite interesting. And the rest of this year could be just blow your socks off with all the stuff you're going to see. On gold and silver, this is gold, 487,000 contracts at close as of today's data. This looks like, today morning data. Delivery, 601 physical deliveries, not a lot of trade in August. You don't see a lot of contracts, only 601 deliveries. But look at EFPs. Absolutely freaking exploded. Exchange for physical, what is that? You take a contract in the US and you go to the UK. Sister markets. This is one of the trade across mechanisms. 16,000 contracts in a freaking day. People are bailing out of the COMEX looking for physical in London. You don't think people are panicking and going to gold? They're going to gold because the market collapses and they need the physical, and you're not getting it on COMEX. There's not enough liquidity, and it's blowing the hell up. Look at Clearport. What is Clearport? PNT is an acronym for privately negotiated trades, which may be reported through Clearport, CME Group's clearing service for over-the-counter markets, or directly into CME clearing. The over-the-counter market is blowing up from the U.S. East, and it's blowing up here. People are going for the gold, and it is blowing up all over. People want gold. There isn't enough liquidity offered in the registered category in gold and COMEX, and so they're trying to get it any which way they can. Private trades moving over. Look at block trades. This is where you have a block of trades off market brought onto the market at the last closing price. Trade after settlement, last closing price. All of these off market, independently agreed things that are then put onto the market are exploding. I've been talking about this for the past couple of months. It's because people want physical and they're panicking. And when you see the stock market across the world have issues and the yen have issues, and it rises up to the level of general knowledge of all the traders across the world, people go for what? They go for gold. That's what that is. People want freaking gold. They can't get it off the COMEX, and they're trying to use any means possible. This is heavy volume. Look at this. 20,000 Clearports, 16,000 EFPs, 4,600 block trades, and as many deliveries as anybody will give you. There's not enough gold on COMEX, and this should convince American investors that when the stuff blows up, when the currencies blow up, the markets blow up, where are people going to go? They're going to go to gold and silver. Period. End of story. Period. End of story. It's smacking you in the damn face in the data. It's like they're taking a fish and just smacking you across the face 100 times. Are you waking up? Are you waking up? Are you waking up? Look at how much open interest we have in the summer. When in the hell do we ever have 500,000 contracts in the summer? Are you freaking kidding me? Gold is blowing the hell up across the world, and it's right here in the damn data on the market. And yet the price is still going down a little bit. Why? Because the short position. I'm going to show you that in the COT report. But here's the settlements. The only reason I ever show this screen is this tells you the price. What's the dominant month? Well, with 400,000 contracts open, it's December, and it was down 25 bucks. What happened to the price in all the local dealers? It went down 25 bucks. The dealers don't determine the price. It's the paper trade. Always has been since 74, essentially. Last 50 years. Here we go with volume and open interest in silver. Same thing, spike up. Look at the EPs in silver. Now, this is 5,000 ounces per contract, and gold's only 100. 35.15 a day. Bam. Look at Clearport. What is Clearport again? It's private transactions cleared over the counter. The block trades, the trade after settlement is starting to blow up a little bit in silver as well. People are going for silver. Gold first as money, then silver. Exactly what we said would happen when the markets blow up is exactly. Okay, last bit of the report is going to be the COT report. We'll walk you through it, and then I'll give you my readout on the whole thing. I'm also going to tell you about the Bitcoin conference and why gold and silver people want to pay attention to that. Because if you ain't paying attention to it, you don't know what's going on, the schemes that are going on with the cryptos and gold and silver and the dollar. It's all entwined. We'll get to that in a minute. Here's the COT report for silver as of July 30th. What you're going to see for silver and gold, if we go down to gold down here as well, what you're going to see is a deleveraging out of both sides by the swap dealers or the bullion banks because they're trying to get out of their positions. Because I think the trade has changed this summer. I think what you're seeing is that as the world sort of blows up, that the traditional fade that we get in gold and silver, the summer's not happening, that there's a lot of support for it. There was a sell-off, but there's a lot of support, and I think the banks are repositioning. You can see that most of the other categories, the managed money, which are the financial houses, are long silver. So are the other reportables, which are family offices and such. Producer merchants are always short because they're covering downside price risk. That's legitimate hedging because they actually produce it, and that's normal. This is a speculative trade right here in the swap dealers. The short side of the speculative trade, 60,000 contracts short to 24 long. Overall, they dropped both shorts and longs, as you can see here. Almost 2,000 shorts dropped and 1,000 longs. That's led to the range trading in silver. Let's look at gold right here. Same thing. Producer merchants are going to always be short. They're protecting legitimate hedging of their actual product. Managed money is still long. Other reportables are still net long. Managed money 185, 586 to 33, about a 5-to-1 ratio, 6-to-1. And other reportables are long about a 4 to a little bit over a 4-to-1 ratio. Overall, the managed money dropped a lot of long positions because of some of the weakness. They're trying to cover their losses as the prices come down a bit in gold. And you can see that the swap dealers released a lot of short pressure on gold, 22,000 contracts. They only released 3,500 long, so a net of releasing about 18 to 19,000 contracts to the short side. Normally, that would have caused gold to go up, and it started to, but then there was massive selling, which is not going to be in this chart because it only goes through July 30th, but massive selling at the beginning of August due to what's been going on in the markets. Let's talk about that. Why do the gold and silver markets sell off when everything else does? If risk goes up, why don't gold and silver immediately go up? Because what you're seeing, the prices are determined by the paper trade. You guys know that. When everything blows up in the world, the banks, other entities like the financial houses will drop positions in the derivative trade to cover their margins, to cover their liquidity. It's margin calls. It's liquidity calls. They need liquidity. So everything sells off at the same time. But what happens is people go back to the least risky assets, which in this case will be gold and silver, and the prices will rise again. Plus, we have the love trade coming up in the fall, where India, China, and the rest of Asia will buy a lot of physical, and that will tend to increase the prices because there are other markets around the world. They're not as big as the COMEX in the London market, but they're there. So eventually what you'll see is a rise in the gold and silver price to cover the love trade, and with the geopolitical, the war risk, and the currency risk, and the stock market risk, and the financial risk all increasing, people are going to increasingly go to gold and silver, but it will sell off first. You'll see the sell off in the miners. You see the sell off in the bullion because those are all derivative trades, stock and derivatives, not the physical, but the physical will come back. And that will eventually propel the miners up as well. All right, on to the Bitcoin conference. Why do you care about the Bitcoin conference? Rob, we don't care about the Bitcoin conference. Why are you telling us about that? We're gold and silver people. Well, because first of all, we're now the Freedom Report and we report on everything, but because there's a scheme. So let's talk about the scheme. So I went to the Bitcoin conference. That's why I didn't have a report that week. We just had the interview with Mel, which if you haven't watched it, you have to go back and watch it. It's awesome. It's called the BIS Nazi Gold and the Sword Beginnings of the US Dollar. Mel Madison is just ridiculously good. That was last Thursday. If you haven't seen it, go watch that video on our channel. In any case, getting back to what I'm talking about, the Bitcoin conference, I went to the conference because I knew that there would be an announcement. I knew that the blockchain is now, the blockchain has been used to create this central bank digital currencies, which is what the central bank wants to give you when the dollar fails. So you have to understand that. If you don't understand it, you don't understand new money and why you want to stay away from it. So I went to the Bitcoin conference, do some research, second time there the last 3 years. This time I spent a lot of time in the sessions and networking with people. We did outside networking, but I spent a lot of time in the Bitcoin conference this time. And I listened to Trump's speech. I was about 150 feet from him in the auditorium. RFK said something similar. I'm going to summarize. What RFK and Trump both want to do is buy a bunch of Bitcoin, inflate the price, and then pay off the debt and supposedly collapse Bitcoin. RFK, the difference was he wanted to buy up to 4 million Bitcoin. Trump said he wanted to buy a million. There's some people on social media telling you Trump didn't say it. I was standing right within 150 feet of him when he said it. And he said they want to take the 204,000 confiscated Bitcoin that the 3-letter agencies already have in the government purview. And then they want to put that into a strategic reserve. And then they want to buy enough to make a million. So another 800,000. Let the price rise over time and then sell it off to pay off the national debt. Well, the Bitcoin price is not going to get high enough to pay off the 35 trillion national debt. It's not going to happen. So really it's a hedge against collapse of the dollar. They think they can liquidate it as Bitcoin goes up and reduce some of the pressure on the treasury market and on the valuation of the dollar. In other words, this is a scheme to buy time. It's not going to pay off the debt. Well, the scheme gets deeper. Because how are they going to pay it off? They said excess Fed reserves. How much excess Fed reserves do they have? Well, it would go from something like 30 million or 6 billion to 2 billion. That's only 4 billion. That's not going to buy you 1 million Bitcoin and pay off 35 trillion in debt. It may buy you some Bitcoin. It's not going to be enough to pay off 35 trillion in debt. So what they also are doing on top of that is they're going to take the gold certificates, the representation of the gold that the Fed holds, and they're going to ask the Fed to revalue it from $42.22, the price of gold when they got them, that's been held and hasn't been marked to market or hasn't been held to the real gold price, and they were revalued for the current gold price, which is somewhere around $2,300-2,400. That's going to create a tremendous value in those certificates, and it's going to, what the Fed's going to do is they're just going to put that increased value on their balance sheet, which is going to cause the Fed to be more financially stable. They're taking their gold and revaluing it, those certificates, as an asset on their balance sheet, which is going to make the central bank appear more stable. And they're going to print dollars. They're going to use Bitcoin as a conduit, and they're going to buy Bitcoin and use Bitcoin to pay off the debt. If they just reflated those gold certificates, took that money and paid the debt off directly, it would cause hyperinflation. If they go through Bitcoin, they think that they're going to destroy Bitcoin on the way to saving the dollar. Well, at least saving the dollar for a while until it eventually crashes anyway, because there's still too much debt. And then they go to CBDCs. What does that do? It destroys the main competitor of CBDCs, which is what? The other electronic currency, the biggest one being what? Bitcoin. I think they're trying to kill off Bitcoin by collapsing it and getting rid of interest in it through this scheme. They're going to print dollars, export that inflation instead of going to China or India or Russia. They're going to export it into Bitcoin. Then they're going to sell the Bitcoin and destroy the value of Bitcoin, killing off their competitor, providing a few more years of solvency to the Fed as they transition to the central bank digital currencies. What technology did they steal to build central bank digital currencies? Bitcoin blockchain technology for Bitcoin, all the other cryptos. And now they want to destroy it through hyperinflating it. They're going to destroy Bitcoin as a currency through hyperinflation and use time to build, to pay off some debt and buy time for the dollar. And then they're going to, when the dollar finally collapses, which it will in a few years, they're going to implement CBDCs. I think that's the plan. That's my speculative. That's not what they said they were doing. That's what I interpret that they're doing, and the outcome of all this based on, you know, what I think the plan is. I don't, and a lot of Bitcoin people were cheering. I was like, oh, that's interesting. But I think about it afterwards and I was like, wait a minute, this could crush Bitcoin. And if you're Bitcoin and you're like libertarian in nature and you believe in Bitcoin because it's decentralized and the government can't control it, isn't the government controlling it now? You've got ETFs, which are going to control monetary flows into and out of Bitcoin, price control. You can have decentralized nodes all you want in the creation of Bitcoin, but you don't really. You got minor pullage. I'll talk about that in a minute. But the government's now getting in by regulating because they ETFs. So ETFs, you get to regulate. You're regulating the valuation of ETFs, which is regulating flows into and out of Bitcoin, which is going to regulate what? The price. And now the government's going to buy a bunch of Bitcoin, hyperinflate Bitcoin, and use it to pay off debt. I think they're trying to destroy it. So I think the government is now trying to control Bitcoin because they see it as an existential threat to the dollar and the eventual digital dollar, the CBDCs. That's my thought. More, right before Trump went on the Bitcoin conference, one of the lead developers for Bitcoin got up there and spoke. And he was talking about the other existential threats to Bitcoin. What are they? Well, there's mining pool consolidation. What the hell is that, Rob? We're not crypto. We're gold guys. Come on, Rob. We're old dudes. We understand this. Okay. When you mine for gold, you have to spend electricity, you mine it, you pull it out of the ground, you manufacture it, you refine it, you sell it to the market. Same with Bitcoin, except for you're doing a mathematical algorithm that once you solve it, you get the reward of Bitcoin. It took energy input. You get a Bitcoin out that in the limited amount of Bitcoin, 21 million, means it has value, right? It also has network value because it allows you to transfer money. That's the hypothesis behind Bitcoin and any electronic currency. It's not a physical thing. It's an ethereal thing, but you put physical things into it. It gets encapsulated in this algorithm. And this algorithm then has value and it becomes some sort of currency, right? Well, you have to mine it, and the miners create the Bitcoin through concentration of energy into these machines, these GPU units and advanced units that calculate all these extremely hard mathematical formulas that are hard to compute with today's technology. So it takes time. And then once so much time, you get another Bitcoin, and then it takes it off the ledger, and you only get to 21 million. Beautiful little digital system there. But the miners are concentrated. And so the concentration of the miners means that these people are getting all the Bitcoin. And so Bitcoin is not being distributed to this vast network of millions of people like they originally envisioned. There are pools of money going into mining. Would not surprise me. The banks are heavily involved. They have to be. Where's the money going to come from? The banks. So the banks have gotten into the mining industry and they're taking over the creation of Bitcoin, and they're taking all the Bitcoin. Is that really truly decentralized? Well, the nodes may be decentralized, but the creation of it's not. And the programming of it is not. It's centralized. And so that's a threat. We still have the small block threat. What does that mean? If you take a block of data, let's say you're transmitting a video up to YouTube, or you're sending a picture to your friend. Depending on the size of the data, it takes so long to transmit that data, right? It could take a minute, it could take an hour. Well, when Bitcoin, the block size determines how many transactions you can encapsulate at one time. And with a small block size, it decreases the amount of transactions, which creates more congestion in the network, which creates more costs and takes more time to do Bitcoin. Well, with small block, Bitcoin isn't fast and it's not inexpensive. And so the developers made that choice. So the developers have made the choice to go small blocks and cause congestion in the network, which caused the creation of layer 2 networks like Lightning and others, which is all that is a banking system. Because for Lightning Network, for settlement, you're off the chain, off the layer 1 chain, and you're settling at this chain, and then it all gets put down through on-chain transactions. Well, the way Lightning and layer 2 works is you have to have pools of liquidity. It's a hub and spoke model. What is that? That's the banking model. The banks have the liquidity. So I think the banks have affected the developers for small block to keep it congested, so that you had to create layer 2, which you wouldn't have had to create if you just open up the block size. And then layer 2 is really a banking network, and it creates money for the banks. And then they control the mining pools, so they can trade all the money that they get from mining the Bitcoin in the first place. I think the banks have already gotten control of Bitcoin in some ways. And so they'll probably exit out of all their positions before the big crash. So there were problems with Bitcoin before the announcement of the strategic reserve. And now the strategic reserve is the government, I think, trying to use Bitcoin as a pseudo currency to hyperinflate it, kill it without killing the dollar, and pay off some of the debt, and buy time till the central bank digital currencies come and destroy Bitcoin and the whole crypto complex, so they can have a monopoly in all things digital. That's what I think. Just my hypothesis. That's why I go to the Bitcoin conference. Now, as a recap, I told you last year the wars are going to blow up into bigger conflagrations. That's what's happened, and it's causing risk. We were right, and we were ahead by a year. We told you it was like January, February when Steve Hochberg came on, we predicted the stock market crash in the summer. That's why you come here. Okay, that's why I cover everything, and I've renamed it to the Freedom Report from Gold, Silver, Pros. If I cover all of this stuff, I can show you the great chess game. I can show you everything that's going on. I can show you what you need to know to survive. And if you don't understand the digital world, you better learn it. Because if you don't, you and your children may become digital slaves. You need to understand that system. And we have to understand it to tell you what's going on in the world, across the world, geopolitically, and the currency systems and the debt systems and the economies, and what the government's doing. If I had been at that conference, I knew nothing about Bitcoin, I didn't cover it, you wouldn't know about all this stuff. And my hypothesis, they're trying to get rid of their competition and usher in the era of central bank digital currencies. And as you're trying to last gasp, desperate attempt to save the buck. And that's why we do it. That's why we cover that. And by looking at this holistically, not just gold and silver, we can predict things ahead of time. And we've got a good track record. That's why you come here. You don't need to go to any other channel. I'm telling you what's happening before it's happening, at least the big stuff. And we get pretty close on our dates. We don't try to hit the exact date. We just try to look at milestones. So that gives you a rough idea of what's happening and roughly when. You don't need to go anywhere else. Just come here. By the way, if you're interested, support one of our sponsors and support us through our sponsor, which is Kinesis. If you're wanting to debank and put your money into audited vaults and get paid for putting it there instead of paying for storage, but get paid to have storage and have a system that lets you transmit back and forth, not only in asset-backed digital currencies, backed one-to-one for gold and silver holdings, but also in the cryptos if you wish, and also do some of your banking that way. You can do it that way. You can debank using Kinesis. The link is right down there. That's my affiliate link. You sign up and go through KYC, establish an account. I'll get a little bit of credit for it. Why don't they charge storage, Rob? Everybody else charges storage. Well, because in traditional storage, you stick it in a vault and you got to pay for the security guards and all that stuff. Kinesis, the word kinetic means to move. Transaction fees and fees power Kinesis. They make enough in fees where they can just pay off the storage and they don't got to charge you for it. And they take a percentage of that fee pool and they pay it out to the holders and the distributors and all that kind of stuff. You can mint it too. You can mint KU and KG, which are the virtual versions of gold and silver. They put in the real gold and silver in the vault. They give you a virtual representation of it, which is audited, and you get full ownership. They don't own it. There's a Bailey relationship. They just manage it, but legally it's yours. It will stand up in any major jurisdiction legally. Those laws are in place. That gold and silver is yours. The system just allows you to transfer it without having to physically ship it. In other words, the modern day economy. That's what Kinesis means, kinetically moving gold and silver around and making it money. This is what you want. This is what they got. I fully believe in them. And I only get something if you fund it and you decide it's a good idea for you. But it does help support the program. And I think that's a way to get out of what I'm telling you with the CBDCs. And I think if you're in Bitcoin, you may want to think about Kinesis, because you can trade Bitcoin on their platform, but it also gives you a gold and silver option in case you think Bitcoin's going to blow up, and literally can make a trade and instantaneously be out of Bitcoin and into cash or gold and silver if you want. And I think Kinesis has a good option for those of you on the digital side of things that are worried about this system, along with the people that are worried about it from the gold and silver side, and gives you a way to transmit and send to friends and family in this network. Very low cost, outside the banking system, but is perfectly legitimate and legal. All right, if you're interested, support those guys. Till next time, Rob Keynes of the Freedom Report. Come here, the only place you need to go. I got your news, and we're going to get you prepared ahead of time. Till next time, see you guys.